Hello and welcome to another Property Solvers podcast. And I'm really pleased to welcome Richard Nicholls, Director of the Property Advantage and HMO Sales Expert and Advisor. Thanks for joining me today, Richard.
That's all right, Ruben. Nice to be here.
Good stuff, good stuff. And yeah, so Richard, I've been following you on LinkedIn for a while now, and it's been really great to see kind of the warts and all insights that you provide into HMOs, which I believe you have over 20 years of experience in. So for ourselves, we've sold HMOs mainly through our auction house and estate agency service, but typically steer clear of buying them. I mean, we have done one in Northwest London, got quite a long time ago, about 12 years ago, which we kind of ended up doing unintentionally, really. And it was good in terms of the kind of cash flow that was generated from the property, but we ended up converting it back to a single dwelling in order to be able to sell it. So I guess my first question is kind of what attracted you to the HMO industry in the first place?
Well, I think it's spotting a niche really, because over that 20-year, 22, whatever it is, sort of year cycle of actually selling properties, I think 5 or 6 years in, being a kind of residential estate agent, I started in that era. You're talking about kind of same-day remortgages and sale and rent back and all of those kind of strategies back in the day. What's this? Probably 15 years ago. So I started sourcing and working with investors and working within the investment property side of things, and found that I enjoyed that more than residential estate agency. It kind of came at the same time as the race to the bottom with fees, I think, in residential estate agency, So and gradually I started thinking, or noticing everyone is kind of trained to, you could, for deal packages that go to all the national training groups and things, they find and add value property. So there's a very sort of chaotic market around property sources and what they're finding, deal packages, and ranging from 80% bad to 10% ugly and 10% good sort of thing.
Yeah.
So that marketplace is just completely full and cluttered and not very reliable. I started thinking, well, who actually specialises in preparing tenanted HMOs for sale and finding out the right buyers for those types? Because there are buyers that only want to come in and buy a ready-made HMO. Not always only, sometimes they fluctuate and develop as well. But over the course of, I'd say 10 years ago or more, I started doing more and more HMO sales and thinking, well, no one's really specialising in giving the landlords the advice of how to exit HMOs. As you said there, a lot of people decide to convert back to resi, or you find that property sourcer that you've maybe bought that HMO from as a development a few years prior, if you go back to that property sourcer to find you a buyer for a ready-made HMO, well, all of their investor databases are wanting to buy a deal and add some value or get a little bit of a discount and things. So there were very few actual services for HMO landlords that, okay, let's look at the positives, the USPs, and let's properly understand how to value and appraise HMOs, and then take those to market as kind of quality ready-made HMOs. So I kind of just fell into specializing it, and then you start realizing, well, obviously if you do niche and specialize in something, then you can be known for that, and word can pass around and you do a good job. And so over the years I've built a big network of landlords that know me and trust me to be that guy that's going to give them the HMO, the tenanted HMO exit. Sometimes we add value properties and blocks of flats and things like that, but very much honing in on that specialist subject.
Multi-let kind of thing. Yeah. I mean, HMOs is one of those sectors that seems attractive from the outset, and you kind of think to yourself, oh, great, I'm going to get 11-12% yields and my pay rate's only going to be 6%, let's say, you're going to get all that margin in there. There's a lot of kind of moving parts involved with it. So do you think enough people have realised the realities of kind of taking ownership of HMOs and actually running a business?
Yeah, that's one of the issues. So I did a lot of data. Obviously I collect in the reasons why people sell, and I chat to landlords every single day. And the life cycle of a HMO, one of the sort of byproducts of specialising in it is that you realise that HMOs are probably the most transient property type of all of them.
Really?
So in residential estate agency, obviously, I was so focused on having to, like every local agent, you've got to market so heavily locally to get your market share because people don't move that often. And then with traditional buy-to-lets or blocks of flats or commercial properties, the investors tend to sit and hold and sit and wait because, they're playing the long game with all of other types of property. They come into HMOs, and because of I think a lot of it is expectations going in that, because the courses have told them that it's going to be this kind of, this level, it's going to be hands off, stress free,
Passive. Yeah.
and passive, exactly, and quit your job and all of these things that happen in the courses world, and the reality is that actually, HMOs do work and can provide what you need out of it, but actually probably roll your sleeves up a little bit more than you thought, or go through a little bit more pain than you realized, and it creates a lot of activity in the marketplace because HMO landlords that go in, buy in their local area, they self-manage, they run them locally, they understand landlords rather than passive investors, local landlords. When I value for them, they've usually owned the HMOs for 10 plus years and they're just reaching the end of that cycle and coming out the other end. When I value properties for, I suppose, the kind of, the passive or the younger generation of HMO investors that have come in on a BRR, so they're trying to just get this massive uplift to refinance, pay angel investors off or JV money and have quite a heavy leverage portfolio. They tend to reach their shelf life after, even just before that first fixed period's up. Because it's a lot of the difficulty to then refinance and stay on a competitive product is quite difficult. So in the HMO, there's so many different reasons why properties are being sold prematurely. From a negative point of view, lack of experience, wrong expectations going in, expecting it to be easier, difficult tenants, managing agents growing too quickly and not being able to provide a service. And obviously, nowadays you've got the interest rates, but I think with HMOs as well, a lot of people rush into JV partnerships too prematurely, so that those separations can trigger a sale. So all of those things on a negative aspect, but it is usually 50-50 as well. So a lot of the other HMOs I value, they've served their purpose. They've provided good cash flow. They've allowed somebody to move through the property ladder, if you like, and I quite often have. So just this year, I've had a couple of people come to me asking to sell their blocks of flats, large blocks of flats, and they're existing clients that have sold their portfolios with me, HMO portfolios with me maybe 5 or 6 years ago, and they use that money to move up into freehold blocks of flats or move into development and things. So, you get a natural progression, and I think the HMO ownership, wherever you are and whatever your structure of management is, it's an energy-driven business. You've got to keep on top of it. And everything I say, with an increased gross yield, you end up with an increased risk, an increased sort of having to either pay someone to babysit it or have to babysit yourself to make sure that those higher gross yields don't become too much of a risk.
Yeah, and end up kind of costing you more, and your overheads get out of control, essentially, right?
Yeah.
So are you seeing that more HMO landlords are selling up in the current climate, given all these risks? I mean, if you've been involved since we have in the sector, since, the day one remortgages and all that kind of thing, I guess a lot of landlords have owned properties in their personal names as well. So, that kind of thing.
That's triggered. So there was always traditionally the tax reasons pushed a few people early, or worries about certain things coming in with changes of government. So you've got that triggering investment property sales. In addition to that, at the moment, since Liz Truss and the interest rates have really changed, you've got either the people that are developing HMOs are very, very highly leveraged, so they're maxed out on a bridge, they're maxed out with private investment funds, and they're trying to create these 6-bed full ensuite or 7-bed sui generis HMOs, and it's very, very tight. A lot of the GDV brochures that they went out to sort of commence that deal with um, don't stack anymore with the current interest rates and the changes during that. So you put plans in, you go through a planning permission, planning application, you go through the build phase. During that process, more costs have doubled, and lender sort of in a lot of parts of the country, and that's caught out a hell of a lot of people that can't actually get off a bridge and go onto a term loan in a cost-effective way. So that's triggered a sale. But the good thing about the people that buy ready-made HMOs is there isn't an add value opportunity. So they know they're going to have to put at least 25% equity in. So it's a different type of buyer. There isn't this BRR crowd where they're trying to just completely leverage and refinance and add value and all of that, which has got its place in the market. But when it's a tenanted finished HMO, it is just, here's the HMO, here's the numbers, here's the gross, here's the net, here's all the running costs. This is what we think it will value up with a lender, and come in and you're going to need 25 to 30% deposit, which equals X. And so the second buyer on all of these on a ready-made isn't over-leveraging, because so it helps.
Yeah. And when you say ready-made, is that kind of an HMO property that's been running for what, 2 years or something like that? It's got kind of demonstrable cash flow.
So we tend to put them into categories. There's a lot of developers that I work with specifically who do HMO flips, because HMO flips, not that many people I work with who do it as a main strategy, because most developers are portfolio building. But if you don't sell every third HMO or fourth HMO, then ultimately your pot reduces. So it's a good way of releasing full capital. So you do a HMO development, 4 or 5 of them in any given area, sell one of them, you get the full sales price, so you get that extra, you're not holding in equity in each property, so you can pull that extra money out.
Right.
So I've got a big pipeline of various developers across the country where I know that there's going to be HMO flips, essentially brand new HMOs coming to the market, and that suits certain types of buyers. And another reason why developers do every third or fourth property they flip on is to keep a sold comparable. So to make sure that their other refinances, because I know where you're based, and obviously the further southeast you go, the more HMO valuations are sort of actually linked to the bricks and mortar value.
Yeah.
Because you've got especially if you're at a 5 or 6 bedroom and you're anywhere within a catchment of London, your dominant variable is the bricks and mortar.
Right.
But the further you go through Midlands and into the north, you're talking about properties that the developers are expecting a commercially derived refinance based on the HMO attributes, rather than actually, because you could be a 150 grand terraced house, but you're trying to get a refinance of 300 grand. And so there's a requirement constantly to be placing sold comparables onto the marketplace to give the surveyors something to actually, because you can't just be keeping on refinancing without having, without giving the surveyors confidence. Yeah, exactly. So the HMO flips and the buyers for those type of properties, I would say a lot of them traditionally with myself over the years have maybe tried to work with builders and tried to work with deal packages, and it's just not worked. And at the moment, if you've got, for argument's sake, in the Midlands, you've got a 200 grand terraced house, which traditionally you could have bought for 150, then you spend 100 grand on the refurb, and you've got yourself a 400k valued HMO, essentially. Nowadays, it's a 200 grand terraced house rather than 150. And if you're a remote investor using a PM and a build team, you're probably going to spend 180 grand on the refurb rather than 100, because materials, and you're paying through the nose. And then you've got contingency, stamp duty, arrangement fees of mortgages, bridging costs, all of these extra things. You end up 20 grand less than just buying it straight away off the shelf. But you've got a year's worth of pain and no income. So I think the cost of materials and obviously Article 4 pushes a lot of, when you're on that thinking, well, I'd like to develop and add value, but if a few little bits go wrong, plus you're on the edge of, an Article 4 area, or you're going to have to wait for a proper application inside, it pushes a few people into the ready-made market, and we've seen that over the last couple of years as well.
Yeah, I guess it depends on your own kind of, availability of time as well, because I guess
Exactly.
if you're gonna get into the HMO industry, it's probably a good thing to learn, to try and like, okay, how am I going to build these units? How am I going to maximize value from these units as well? I do find it a little bit scary, this whole idea of refinancing HMOs, so yeah, in the Midlands, for example, you get £100,000 building, then you turn it into an HMO and then you get it valued up, and then yeah, you might be able to pull out a load of money from the property, but then what happens if things go wrong, like an Article 4 directive comes in place and things like that, and things start to change, then
Yeah,
you
so
with it's like a lot of leverage without being able to necessarily.
there are obviously there are best practices to go to. And if you're in an area where you've got that multiple tenant base, you've got strong. I mean, I spent the whole of Wednesday going across different parts of Manchester, really, premium parts of Manchester, where you are going to get the young professionals. You're in an Article 4 area, and if you tick off certain, a lot of time when I go to HMOs, I'm looking at, does it justify the valuation above bricks and mortar? So you've got what the house is worth, what the conversion cost. Those two things are fairly fixed. But then on top of that, how far can you go from a sale price? Is it Article 4? Does it have a lawful development? Has it got, what tenant type is it? What lease type is in there?
Yeah.
And obviously future-proofing it and looking at the room rates. And on the ready-made market, there isn't really as much risk because the buyer's market will dictate what it's worth, and they won't overpay because they're using their own capital, and they're not just creating a valuation pack just for the sole purpose of refinancing money out.
Right.
But
yeah.
what you tend to find on the HMO development world, the primary focus for a lot of people is, I'm very good at raising angel investment. So that's what I'm good at. I've got an online presence. I'm very good at raising, private finance. Let me find a property that allows me to execute a BRR to basically own a property without any of my own money, because this is obviously what courses teach. And if your primary focus is find a property cheap enough, end up with a GDV value high enough where you can pay everyone back and then still retain the property, you're walking into an over-leveraging situation. And a lot of those fair weather developers that are using other people's money, they shy away from Article 4 because they haven't got the time to wait to put proper plans in. They don't know the local. So you end up, your presentation will be numbered based on a property in Salford. You're not in Salford. You suddenly, all of a sudden, you found yourself in Oldham or Burnley. So you're able to raise angel investment. You're even nowadays able to probably hoodwink a Shawbrook that you're going to get £700 average per room, and you're going to get this long list of working professionals. And so you end up refinancing a HMO in a secondary town on the outskirts of Manchester for the money that you should be refinancing at HMO in a solid prime area.
Yeah.
You get away with it. You pay your JV back. You buy them out. You have your refinance, and you go out for your glass of champagne. But then 3 years later, when you've had a rent roll of 700 average across 6 rooms on day one because it's a brand new product, 3 years later you're down to 550 because that's the mean average of the local area.
And you've got wear and tear and all those kind of things that come into play as well, right?
Yeah. So then you're asking the valuer to come out again and value at the same level that you were at previously, otherwise you're going to go onto the variable rate. And the valuer says, well, okay, even if I was at the same yield that I gave you 3 years ago, you're now 20% less rents. So rather than getting 400 on a refinance, you're now getting, I'll give you 320, take it or leave it. So
then
if you've got to put the money back in, and you haven't got the money because you've paid that JV person back. But if you're buying a ready-made and you've got your equity level, if you had a little downval, or if you had fluctuations, then you're just spending your own money.
Yeah.
But so it really does matter where you're developing these HMOs, because in prime areas, really hot Article 4 areas, or areas that you've done proper research in, over that 3-year cycle, you will see rents go up. You will see the demand of the property go up. You'll see that the Article 4 has more, impact over that time. So the surveyor comes out in 3 years later, and they're very happy to give you 425 next rather than 400. But the developers that get that right are the ones that understand their local area and they're prepared to, whereas and their primary focus is tenants, is occupancy rates, is the desirability of the location, the local economy. Their first primary objective isn't where can I find an empty shell that's going to give me the ability to facilitate a VRR to then own a property of none of my own money. That is the sole, and unfortunately that triggers, let's say 10 or 15% of the HMOs I value are because of that negative reason.
Yeah, I guess it comes down to quality and also investing in your property as well. So if you've got HMO rooms, it's not just a case of just, taking that, as we said before, this passive approach. I guess you've really got to like make sure that your rooms are up to scratch, they're in demand, you're not just turning the property into some kind of slum landlord kind of situation,
and it costs to maintain that. You put an allowance in 5% for maintenance, 5% for voids. You've got all your, and ultimately, I interviewed I surveyed 100 landlords this month, and I'm writing an article at the moment for someone where I asked to achieve a genuine net £1,000 a month out of a HMO, genuine net, so not free lending or variable. So after everything, what gross income do you actually need to be at to get to £1,000 net? And it was, for most people, it was 42 grand a year plus, which that's the reality. So there's nothing wrong with having £1,000 net, but that isn't allowing for probably 5% maintenance, carrying a little bit of voids. I think I put down that assume a 12% management and assume a mortgage at 6%, because I wanted to make it current with a hands-off investor, because I'd rather be realistic and say, so 42 grand's worth of income as a minimum. What's that per month? So this is the top of my head, by the way. I've not got a calculator out. So 3.5 grand. So 3.5 to 4 grand gross on a property will give you £1,000 net.
Minus your insurance costs, your maintenance costs, your mortgage costs, just factoring all those.
Well, so that included
at the same time as well, right? So they're constantly kind of going up. I mean, I know the inflationary pressures have calmed down a little bit, but you still got to bear that in mind, right?
Well, I included on that. So the £1,000 would include the mortgage, the landlord insurance. Basically it's a true net, which there's nothing wrong with that. £1,000 true net. But if you're at 4 grand a month, so let's say you've got a property that's generating 45 grand a year, and it's in an area where you can pick that up for 12% gross yield, you're going to pay 375,000 for that 45 grand a year net. That's what it's going to cost you. So you're going to be paying 375 grand to get a grand a month net in that region. And that's true net after everything. But unfortunately, on the deal sheets and in the training courses, that exact same property will probably be listed as giving you a 2 grand net,
right?
Because they don't include certain things that the actual realities of being a landlord or having to pay through the nose for stuff.
Yeah.
But the article is going to end on a look. If you can make it now at that 1,000, and if you can put that 1,000 to one side over that 3-year cycle, when you come to refinance, 3 to 5 years, you're probably going to refinance lower than 6%. So that gives you back, say, 250, 300 a month. The utilities will probably be lower in 3 to 5 years' time, because we should be past this cost of living. So you may be at 1,100 net on the same property with the same gross in 3 or 5 years' time, which, it's a case of, if you can make it work in the tough times and still make a profit, is the point of the article, really.
Yeah. And I guess it's, I think the demand for HMO rooms is going to increase. We've got rising immigration in this country. The chances of being able to increase your rents over the next few years, I think, are pretty high. I'm not sure by how much, whether, there might be a bit of an affordability issue coming into play, but I think you are.
It comes down to what market you're in.
It
comes down to what market you're in, because if you base it on social media and Instagram and all of the award ceremonies that we see out with the best HMOs investors of the year, all of the products that get created are for this. The amount of times I go to a property and the landlord or the developer says, or the HMO officer said that this is the best HMO in town. This is the best one they've ever seen, you know. So obviously there's a pride, you know, which is a positive pride in the product, but just to solve the housing need that HMOs are there for, not every single HMO needs to be a boutique all en suite with a kitchenette in, because as you say, the price point will be the cost of living at 700, 800,000 pounds per unit, and we're talking getting on for £800 for a studio room in the Midlands on some of these developments, and there's only a finite amount of people on the third, probably the 30%, you know, stress test for managing agents can actually afford those rents over a long period of time. You get short-term contractors and short-term NHS workers, and you get a transient tenant type that come into a blue-collar area, pay these all, you know, these top, really high-end HMO rooms, but you're creating, you know, you've got 12 changeovers every year on a 6-bed because they're coming in for 6 months at a time. And then you'll get it, but it's wear and tear, it's churn. So you're losing that on your net bottom line somewhere else. It's not the room rents, you're losing it on the churn and the maintenance and the management costs.
The management,
So there's, in every area, there's a stable baseline. And I think providing HMOs that suit the local demographic and not just aiming for the top HMO everywhere is probably what most, that's the difference between being a local landlord and being a remote BRR developer.
Sure.
Yeah.
And yeah, as you mentioned, there's a lot of different segments within the HMO space. So you've got high-end co-living, you know, which are these kind of flashy units. They don't seem to be as around as much as they were a few years back, pre-COVID, you know, like those kind of the ones which have got cinemas and all that kind of stuff, you know, and bars.
Yeah.
What were your thoughts on that kind of sector of the market?
Yeah, I mean, they do have I mean, they have their place, but the thing is, the same as I said before, these decisions have got to be tenant-led, and you've got to be in an area. So the guys that I know that are doing them and doing them well, they know what the local tenants want. It can't be almost ego-led, or, you know, I want to go on Instagram and show that I've got this cinema room, and, you know, because you can get it wrong. The amount of properties I go to that were originally set up for co-living, and these communal areas and these really kind of, you know, these extra bells and whistles just aren't being utilized because the local tenant demographic actually, and you say there, you're right, post-COVID, a lot of people just want to squirrel into their rooms and be as self-contained as possible. So nowadays, the trend for, look, how big can we make these rooms? How comfortable can we make them? How much is the local authority, because it depends very much on different local authorities, how much are they allowing us to have in terms of self-contained facilities, you know, running water or a little kitchenette area. Some councils still you know, allow hobs in there, so it really is like a small little flat. And yeah, the trend has been pushing into those really, and making individual tenants own private spaces the priority rather than the co-living. But there are still examples of it, and it's very much, you know, I think one of the posts I've put out recently or a while ago was, you know, you've got to attribute your local, if you want to go and invest and create HMOs in Barnsley or Doncaster, because that's where you've identified as the patch, you either live locally or you want to go there for the financial reasons, and then you go on someone's co-living HMO course who lives in Brighton and who operates HMOs in Brighton.
Poles apart, right? Yeah.
Yeah, because there are very, very different parts of the HMOs are. This is why I spend, you know, I go and visit every single HMO that I value, and I drive around the country, every single part of the country, and they're so different. And, you know, the difference between what always works is consideration, space, you know, basic amenities and basic access to travel, to hospitality, to amenities locally, and providing something clean and comfortable and spacious. That's universal. But then anything above that or below that, where it's very much the local tenant market that will dictate whether it works or not.
Interesting. And are you involved with like student HMOs?
Yeah, I was at a couple this week actually. Yeah.
How's that space at the moment? I mean, I know HMOs are kind of increasingly competing against PBSAs and things like that. How do you feel about that particular sector? Or does it depend on the area and where you're doing it?
Yeah, I mean, there are some student locations where it's very obvious that the purpose-built accommodation has really ripped a hole in the market, and if you haven't got a plan B, then I'm thinking of, for example, a few years ago, I kept on getting asked to go to HMOs near Warwick University, which is just outside Coventry.
Yeah.
So it's classed as, it was a Coventry postcode. I thought I was going to, the first time I went there, I thought I was going to Coventry. It's actually sort of a few miles out. So there's no other reason for HMOs to be there.
Right.
But you've got all of these student landlords with properties that are now less popular. You've got two decisions. You've either got to undercut the accommodation that's being purpose built and then survive on years twos and years threes. So essentially you're surviving on, 2/3 of the time that people are going to be there, and then have your house suitable for when little cliques are formed and you've got little groups of 5 or 6 friends, then they come into these other houses. But obviously
really step up your game in terms of the quality of the units that you're providing as well to compete with the
in places like that. And then in other areas you're still vastly undersubscribed, the amount of available rooms, and like parts of some of the larger universities that you've got traditional group of terraced houses, those Victorian areas which are slap bang right by the university. You're talking like places like Jesmond in Newcastle or Headingley in Leeds, and then where the demand is really still high, in Fallowfield in Manchester, places like that, because there isn't any support from the local authority to produce any more HMOs. So even if there's built accommodation, you've got increasing capacity, increasing attendances going to the university anyway. So they still work really well. And then places like Chester, for example, the Garden Quarter where the HMOs are in Chester University is growing, but there's purpose-built accommodation going up all over the place. But the little Garden Quarter, it's so close to town, and it's so close to a lot of the amenities that actual different working professionals would want to be at. So you can flip and change tenant demographic on a lot of them as well as a kind of plan B. Yeah, but the student market is always particular. You tend to find that buyers. So a lot of investment funds are interested in just local group university cities and towns and buying student portfolios because of long-term growth.
Yeah,
they tend to be in higher value areas of the actual city or town. So obviously you don't find a university campus with a council estate around it. It's usually got the prestigious old buildings, and those are big old traditional student digs. And then the resale market is often quite active because a lot of them are picked up by the bank of mum and dad and things like that. So you get kind of, little John T from Berkshire going to Cardiff Uni, and his mum and dad buy him a big HMO for him and his mates to live in for 3 years. And then obviously a lot of people who are able to afford investment properties, who've got good jobs in big cities in the UK, they went to university themselves, usually. And then they think, okay, I've got a bit of spare money. What do I know? Well, I'm going to shit my pants to buy a HMO with blue collar workers in Barnsley. Going out to sort of, I just don't understand that. But what I do understand is I went to Newcastle University. I know Jesmond. I know it's so popular. There's so many students there. So I'm going to put my money where I know. So that props up a lot of the student resale market.
Yeah. And I guess it's trying to understand the student demographics as well, like what's actually happening in the area. Is the university expanding? Are intake rates going up and that kind of thing, kind of keeping an eye on all those kind of statistics, which I'm sure are available these days, right?
Yeah, and speak to local experts, really. That's the key. And the student markets are very different, and there's a lot of feedback, for example, with overseas students that have been pushed out post-COVID, and then slowly they're starting to return. But obviously that's got a 2-3 year drag, because if you've got no first years in 2020 and 2021, then you've got a drag of that going through the second, third, fourth, and fifth years, or whatever that works like. So I've had lengthy conversations about that happening in places like Exeter.
Right.
But then year on year now they're seeing the occupancy levels to somewhere where they should be.
Sure. Okay. And then I know we touched on it briefly, but the the kind of other end of the HMO scale, which is kind of seasonal workers, factory workers, contractors, and that kind of thing. Is that just a super risky part of the market, or
it's all down to management. It's all down to management and understanding the local tenants and giving them, there isn't any difference in personality traits on the whole between somebody that's in a white collar professional job or somebody that's in a factory working job or is working as a contractor. They're all similar people, and I've been to properties. Just it's about how to manage them. It's about giving them the products and the property that and respecting them and giving them the correct property. And obviously having the right managing agent in place that understands that tenant demographic. You go to a lot of the areas where there's large Eastern European tenants, and you'll find that there is, Eastern European specific managing agents that, know where to find the tenants, know how to communicate with them. Would I be owning for example, in Boston, in Lincolnshire, where it is lots and lots of, Eastern European agricultural workers, the HMO specialists in there are, from the same nationality who understand that they call them the gangs. They take them out in the morning and take them to. So all of that. Would you be going to Belvoir chain of letting agents to run your HMO in Boston? You wouldn't. So it's I think you have to expect different tenant traits, and I think usually there's two reasons why I tend to increase a gross yield on a property. It's a lot of the time because you're going so far above the bricks and mortar. So in the cheaper parts of the country, on an HMO valuation, it can be 100, 200,000 above the bricks and mortar average for that street. So you have to be mindful of giving the investor that they're not going to get capital appreciation. That's not the drive behind them buying there. The drive is a very high monthly cash flow capability, which comes from a high gross yield. But other times, I'm adding a high gross yield in because of the risk factor, because of the tenant demographic can be vulnerable and can be more susceptible to and also just less stable. There's people that are in and out of jobs and fluctuating, or in and out of relationships, and it's just that stability factor. Really. And then you go to the other side step, which is the supported living and social housing, and a lot of that sector, which is a whole different can of worms, really, with the bad and the ugly of that sector. And there are lots and lots of landlords that have worked with tenants, especially in more perceived risky areas or less stable tenant base areas, and they reach a point where someone offers them a 5-year fixed lease, guaranteed rent, inverted commas, and all bills included, and they see that as attractive because they've had that stressful period of dealing with tenants that have been causing issues. Whether they notify their current lender that they're changing and putting in different tenant types and putting a lease in place is another matter. But a lot of mortgage breaches go on in that sector. So,
and it's a similar thing for I know there's some landlords that kind of lease out to kind of social housing providers and LHA type accommodation. What are your thoughts on that particular area, where you buy a property, you may you refurbish it to HMO standards, and then you just let it out to a company who leases it for 5 years?
Well, again, it's if you know what you're doing and and you're able to manage that process. There's a lot of people that genuinely specialize in it, that have been doing it for 5, 8, 10 years that I know of, that understand the right type of providers to work with, understand the right contracts, and understand the landlord's obligations. There's a lot of other people that rush into it. So I quite often see deal sheets where it says, I did one the other day, and it said, guaranteed rent, no bills to pay. But what the landlord receives, £125,000 a year rent. That's the landlord's net income, because everything's paid for by the provider. So it's so much better to buy that rather than having it as 125 grand a year rent. I think it's actually 140 a year. Gross, and then you're netting back all of these costs. But I looked at it and thought, well, that's a little bit misleading, because the interest rates and the loan to value with the lease in place, if you went to the market, the interest rate was 7.9%, with a 70% loan to value at best, 65% for most people. So actually the mortgage costs, that extra 2% on the mortgage costs, because that lease is in place, that's probably most of the operational running costs, or at least sort of 80%. So if you're going into these leases and you're seeing the headlines where it's, tenant pays all the bills, it's a guaranteed rent, there are certain lease types where your interest rates and arrangement fees and just the holding costs of your loan will be so much higher than the loan to value. So the money you're going to leave in.
Is that because the lender just looks at it as a bit riskier?
Yeah, and I think reputational damage, a lot of them, because if they need to repossess, how do you get rid of 6-7 vulnerable tenants?
Yeah.
So and speaking to a specialist broker, I was chatting to a specialist broker yesterday. The lease has to get sent across to the lender. They have to look at the lease. They have to understand it and approve it. It takes time to get these mortgages, off the ground, and then the lenders need a little bit back because of all the risk factor.
Yeah, makes sense. And on that note, how is the lending market for HMOs at the moment? I mean, are they still after low loan to values and high pay rates? How is it at the moment? Is there any kind of green shoots of improvement, or is it still
I think it's still anybody that I know with the sales we've made recently who have just snuck below 6%, 5.75, 5.85, then they're paying a really hefty arrangement fee. So you've got to pay. You're paying through the nose one way. I think loan to values and everything like that is fairly consistent. Most people are getting the 75%.
Okay.
In most areas where there is a genuine demand and the HMOs work and they're good areas, good Article 4 areas with good long-term potential, then they're still valuing up as they should. I think I've sharpened my pencil a little bit, so I'm understanding that maybe in 22, if I valued property at 10% gross yield, I'm probably valuing it at 11% now, just to give that extra 1%, because HMO prices in theory, using that rule of thumb, have gone down over the last couple of years on a single sort of yield shootout. So, but where that doesn't actually hit the landlord in the pocket is over that 2-year cycle. Very good HMOs tend to have increased their rent roll. So if you've got a property that was bringing in £35,000 a year, and in 2022 I valued it at 12%, I'd value that property at 290,000. Well, if that property is now bringing in 39,000 a year, but I'm valuing it at 13% gross yield because I need to give a little bit of a yield back to the buyer, then it's now 300,000. So it's gone up by 10 grand, but it just hasn't gone up by 40 grand.
Yeah.
So it's a yield rift, which the lenders are happy with and the buyers are happy with, to say, 13% gross yield, like all the comps at 12, great, I'm getting it, but with good HMOs over that period of time where certain factors have worked against the landlord in terms of their valuation, the one thing that's gone in their favor is that in good quality areas for good quality properties, rents have risen.
And they've looked after the property well, and they've been able to sustainably increase rents and that kind of thing. Yeah.
Exactly. Because there is the
sorry. I was just going to ask, who are the lenders out there at the moment? Is it, I know Shawbrook, they're pretty heavily involved.
Yeah, Shawbrook, Kent Reliant, Aldermore. I mean, together everyone goes to there. You've got Cambridge and County. You've got, there's a lot of lenders out there.
Right.
Well, Paragon, Precise. There's and I think from our perspective, when we bring buyers in that require lending, we've got a couple of experienced brokers that we pass them through, just to make sure before application, you're not. And again, the further north that you go, it changes. But so in a London market, usually you're just getting a valuation at bricks and mortar level, and that's that. And it depends which product and the competitiveness of the rates sort of thing. But the further north you go, it is very much a case of only go down this funnel, but here's your interest rate, this is what it is, here's your arrangement fee, because this is the only lender that will support a valuation up to the purchase price in that area. So it's that specific knowledge that we rely on a couple of expert brokers for.
Yeah, it's similar to the single let market as well. There's certain lenders that just won't touch certain types of properties. Even in what you think would be good areas, they'll just say, look, we're not interested because it's close to a commercial unit or something like that. So you just work with a good broker, I guess.
Yeah, exactly.
So in terms of valuing HMO properties in the current market, you're mainly looking at the yield at the moment. Are you just kind of looking at what the property generates in terms of
Well,
income?
you ultimately you arrive at a yield at the end, really, because obviously ultimately you've got an income, and then you end up with a price that you value that. But the factors in play, obviously, bricks and mortar price. So you work out roughly which part of the country it is, and I've got obviously the programs where you can attribute what the non-HMO price, the value would be just for that asset. Then you've also etched in my brain, I've got a kind of a yield sliding scale for that part of the country. So it could be between 8 and 11%. It could be between 11 and 14, whatever. So I know roughly where I am in that band.
Yeah.
Then one of the tricks I do before I visit property, usually the landlords, when they ask me to appraise, they give me photographs, and the photographs are normally when it was first renovated. So the biggest acid test is if it's a 6-bed and you divide the overall income by 6 and you look at the average that the tenants are paying. Tenants don't lie. What they pay 3, 4, 5 years later, it comes out in the wash. So if I look at that and go, oh, right, okay, well, the average in that area should be 600, but this is only getting 450, I know to err on the side of caution. Yeah, and vice versa applies as well. So a lot of it is, the acid test is the bums on the seats, really.
Yeah.
Then I'm looking at, obviously condition, everything that you would normally do as a valuer for the residential property, all the conditions and all of the local area, things like that, and the local valuation, square price per square foot. HMO specific, you're looking at the planning class use, you're looking at the lendability. So is it too small that you won't even get a hybrid or a nod to a kind of income derived valuation? 6-bed all en suite or sui generis HMOs tend to be able to obtain higher lending. Is it in an Article 4? Does it have a lawful development certificate? What's the tenant type? What the lease types are? There's that second layer. There's a lot of variables that are HMO specific.
Tick box kind of exercise, to go through.
Yeah, and you're just collecting a group of USPs, and the less USPs that HMO has, the closer it will be to the bricks and mortar value. Is essentially how it works. And then the converse of that, where the opposite approach tends to be a lot of the time in London. If you say, okay, well, 8% gross yield is probably where it should be at, but you're at yesterday I was appraising a property in Clapham, which is 1.25 million just for the house, and bringing in I think it was bringing in 80 grand a year. So you forget about gross yield, forget about anything. It's just who's in the marketplace that wants to own a piece of Clapham real estate for the next 10 years and have it, because the driving factor there is it's going to go up 50 grand a year over the next 10 years.
Yeah, you've got that capital gain guarantee, almost guarantee. Unless, black swan event happens or whatever. But in London, I guess it's a different kind of market because the yields you're going to get in London aren't going to be kind of, unless, I don't know, it's going to be hard to get double-digit yields in London, I'd imagine.
No, yeah, exactly. So you tend to get, and they are out there, but if there was a double-digit yield inside the M25, you'd have to think, what's wrong with this property?
Yeah.
Because the higher the yield, not always the better net return. You've got to look at manage expectations of the mindset of a buyer as well, thinking, well, buy to let standard AST, one family in there, that yield may be around a 3% or something like that. And then a HMO yield may be no more than an 8%, but it provides greater cash flow. And I think, Article 4, not being able to convert properties for 5 and 6 beds, you may be £500,000 just for the terraced house, and you might be able to get 525, 530 for the HMO or something, because it's got lawful use as a HMO. It comes with the grandfather rights. It's got the furniture. It's got the tenancies, all that sort of stuff. So you've got a rarity factor that you can't just go off and create. But in the London market, you tend to find higher value of the area. You need to just keep on going up for more bedrooms and more income to make that yield calculator actually have an effect on the bricks and mortar. So the bigger they are, the more likely you are to just do a commercial valuation.
Interesting. Well, this has been a fascinating conversation, Richard. I really enjoy it. It's an area that I'm not too tapped into. I've always kind of fancied doing it, but I don't know. just never really got into it. We kind of stick with single lets and trading at the moment. But yeah, so Richard, how can people find out more about what you do at the Property Advantage, get in touch and all that kind of thing?
Well, so it will be, the new website is actually www.hmosalesexpert.co.uk. Or they can find me, on social media. I'm quite active on all of the Facebook community groups and the HMO community groups. And then, I think just over the course of this year, we were talking before we went on air that I'm a guest speaker this Friday and this Friday coming up in London. There's a lot of speaker slots that a lot of people are interested in trying to be as real as possible with how to value and how to appraise and the actual numbers behind HMOs, really. On my average day, I mean, I've valued nearly over 300 now this year already, and visited probably 100 myself this year. So you just start to collect all that data in. So I think the LinkedIn profile and Facebook profile would be fairly active, but there's a blog as well on my HMO Sales Expert website.
Brilliant. Good stuff. Well, thanks very much for your time, Richard. Really appreciate it. And I'm sure this will be of interest to our listeners. So
good. Thanks for having me, Ruben. I really appreciate it.